Hey everyone, hello and welcome. This is Tech's March 2024 review of the monthly CNO Trends Report. Thanks for joining us today where we discuss the events that have shaped our market. I am Rob Schregast, head of Tech's distribution team. We do this in conjunction with Fin, the Fixed Income Investors Network, who serves as the vanguard for investor-led initiatives within the structured credit markets. For our part, during this time, we invite influential players in the CLO space to join us to share their views. The slides we discussed today will be sent to all of our CopenTech platform members. If you're here and not a member, you receive this package just this one time. However, we do encourage you to join. You can find us at copentech.com. That's Copentech with a K. For more information on Fin, you can find them at thefin.org. That's THEFIIN.org. Today, I have the pleasure to introduce Michael Shinners, who is a senior structured product research analyst for the global fixed income research team at Allspring's Global Investment. He came to Allspring from his predecessor firm, Wells Fargo Asset Manager. Altogether, he has about 16 years in with both firms. Prior to Wells, he worked as a senior manager of credit risk management for Washington Mutual Bank. Earlier, he served in a variety of roles at GMAC Residential Funding Corp. And also as an accountant at KPMG. He began his investment industry career in 1984 as a financial analyst at First Star Corporation, and he earned a bachelor's degree in accounting and master's degree in business administration from Marquette University. Mike is a chartered financial analyst as well as a CPA and member of both the Minnesota Society of CPAs and the CFA Society of Minnesota. Mike, thanks for joining us very much this month for the March review and the first quarter end review. How you doing?
Yeah, I'm doing great. Thanks, Rob. I appreciate you inviting me, and I apologize you couldn't find somebody influential, so you'll get my thoughts. Just before I get started, just by way of background, again, my views today are my own and not that of Allspring, so take that with a grain of salt. And also, really where I fit into the global Allspring platform is. In our Plus suite of products. So, help support a core plus bond fund, an ultra short, and income plus. So we're kind of all over the curve, both in credit and in duration. Allspring itself has about 515 billion of assets under management, and of which we're probably 20 billion kind of in the group that I'm focused on. My structured products focus, I guess, covers a broad array of things, non-agency related. So I do look at ABS, look at CMBS, non-agency, SASB, CRE CLOs, and some RMBS. So try to take I won't say I'm diving too deep into everything, but try to have a view on most sectors of the market.
No, I appreciate it. No, it's a great perspective, relative value between the different sectors. I mean, that's different things that we want to hear. Within the CLO space, are there what part of the ratings structure do you typically? Is there a part that you focus on? Are you looking at some of the primaries or the secondaries? How active? What part of the CLO market are you looking at?
Yeah, generally, we're looking at the secondary space. We typically prefer something that's kind of nearing its reinvestment, at the end of its reinvestment period. Just focused on spread duration generally. We will participate in new issue if it's a shorter deal. Typically we're playing at the top of the capital stack, but we will, buy credit down to triple B. But for the most part, we're focused on the AAA space.
Great. Okay. Well, we're glad to have it. And with that, so we'll jump right in here. So we'll start out looking at the trace market, the secondary market here, and I mean it was a solid, we about 18.35 billion in trace. Finished up really solid quarter here. Kind of coming off the tail of January, which was super strong, over 25 billion traded them. Overall, it was a strong month overall. What are you seeing over here?
Yeah, I mean, I think it's been a brand new year for sure. Since the start, it's been quite strong. I think January started it off. I think everybody seemingly came into the year a little short on duration, and so added some duration and some risk. And I think fund flows have been very good. Kind of driving some of this demand. So even though March looks a little lower, high yield is still a little higher than average, and I think it's still a pretty strong month overall, just given the number of days. We had a day off, we had a half day, and seemingly quite a few Fridays, which
Yeah.
may impact it as well.
Yeah, okay, well, let's take a look at the daily thing. But I guess one thing you do notice here is the high yield portion of it. We're slightly above last 12 months averages in high yield and slightly below last 12 months averages in investment grade. Actually, we don't see that come through in the BWIX. But again, going into what you're talking about on the daily trace days, we've had an average just under a billion for the month. 10 days above a billion. We had 10 days last month. I think all of that is, and you mentioned the Mondays too.
Yeah. I don't know what happened on the 11th of March. I think a religious holiday started that evening, and so there may have been some travel. But we did have kind of a bunch of days that were a little bit odd. But just for reference,
Yeah.
ABS traced daily volumes about a billion. CMBS is less than a billion, and RMBS is almost less than half billion. So you're looking at some pretty good volumes relative to other asset classes too. Quite a bit of liquidity.
Yeah, and I mean, if you look back at prior months, the dispersion actually is quite tight. You do have a couple of days on, you mentioned Monday and Fridays, and at the end of the month there on the 28th, ahead of a holiday weekend, lower, but overall the dispersion of the days isn't too bad. So basically, do you feel that there's adequate liquidity in the market right now?
I do. I mean, I think just looking at just looking at daily volumes into April as well, it's still pretty active, and bids are and pricing is pretty firm.
Okay. All right. So let's move on. Let's dig into some of what the BWIC numbers are telling us, because we can't pull this out of the trace data. The top of the cap stack looks relatively flat. Maybe a little softening up in a double B. But what's your feeling about this? What we're seeing in dollar prices of CLO tranches?
Yeah, everything seems to be pulling to par. There's a lot of par priced securities out there, not only in CLOs but in other asset classes. But just from a CLO perspective, it looks a lot like 2021 into 2022, where pretty much anything above investment grade above was close to par. I think that reflects levered loans too. I think I saw a figure that roughly 40% of loans are priced at par. So there's been strong demand, and so I think what we're looking also at is manager tiers have tightened. There really isn't as much dispersion there. New issue in secondary market has tightened a little bit over the last few months. So you've got that. I guess just some excess returns. I mean, from our perspective, we've struggled to get super excited about the space, just from a relative value perspective.
Right.
I think there weren't many sectors, frankly, that are really kind of obvious buys, let's say. And you look at CLOs, for example, AAA, excess returns were zero year to date. Investment grade was 1%. So there is that decision point. The double Bs. I think you can you can talk to it as well. But it looks like some of the older vintages were kind of out for bid, and that's kind of what drove some of the March figures down. But maybe you can get into that as well.
Yeah. Well, you mentioned this on our call coming into it, and certainly that was the fact. Where compared with February, we have February March prices here. That as you suspected, that there were more deals that were older vintages. About 58% of the deals in Double B that came out in March were past the reinvestment period, compared with only 44% in February. So overall, in what was sold in the triple B space, 91% of that was vintages of 2018 and earlier. So yeah, some more seasoned portfolios that were, that there are kind of frozen there right now, that we saw come out. Yeah.
Gotcha. Yeah, I mean, flows year to date into mutual funds. I think the annuity business has been really strong. So there's been a lot of money to put to work to start this year. So I think that partly explains some of the price action.
Right. Okay. So we look at the share of BWICs within Trace. Relatively efficient month, meaning that 65% of the BWICs that came out traded. The volume for the quarter was substantially the same. We've got roughly 2.9 for both. Well, actually, all 3 months, or about 2.9 billion all 3 months. It's interesting to see that in January. Not to rehash history here, but as we'll see in the future, dealers might have played a long part because they had gotten long. They still are long, and so perhaps there wasn't a lot of buying, but direct, buying from the dealers. Well, I'm saying that's probably what happened over there. But it was a nice, efficient month in BWIC. So a good portion of what was put out there in BWICs have traded. Overall, we're up compared to last quarter. Again, we're up about 9% on BWICs traded, which is a good thing to see as well.
Yeah, I think given the basis between new issue and secondary too, I think folks are a little more comfortable, trading on the BWIC side. As well as, I think you can definitely pick your maturity profile and what have you a little bit more careful if that's something that you're trying to manage.
Right. Okay. Now, when we look at hey, we have the charts that we're charting high yield and IG share of trace volumes within the BWIC space here. So the blue line represents the total BWIC of traded within, and that's 16%. So we have 2.9 billion in BWICs traded, which is 16% of trace, and that's about average what you see, anywhere between 14 and 20%. We'll look at this again lightly again here. A good portion, if it was high yield, will be kind of revealed when we break down just in a moment here. Was a good portion of investment grade traded, and it's really kind of driven by the AAA. But a decent month. It really shows you how much more we can do in the BWIC space, because there's a lot more to go to make this space more efficient and have competing processes in here, with only 16% of the market doing that.
Yeah, I mean it's a like you say, it's an efficient way to gain exposure. Particularly within the maturity profile that you're looking for. I think it really depends. I think in terms of some, partly a reflection of fund flows and some of those items. So, but it's certainly an opportunity to see a little bit more volume through the BWIC process.
Right. So through Kopitech's BWIC platform here, we can dig into all the details of what traded. And here we break out for the month within the BWICs, and you can see here an outstanding month for BWICs in the AAA space, which really hadn't been the case for the month. Just by comparison, that great month that we had in January, so only about like 730 million traded in AAA. Now we've got 1.9 in AAA for this past month, with the rest of the capital stack kind of falling in line just below in the BWIC space, that is, where they are on the LTM average.
Yeah, I mean, I think January you saw a lot of volume in the triple B and double B space, and since then spreads have come in,
Yeah.
60 and 70 basis points. So, good timing there, and, probably taking a little bit of a pause and thinking about where spreads can go from here. The AAA, obviously a lot of liquidity in the AAA. I also kind of wonder or speculate anyway that, there's a fairly new buyer in the marketplace in terms of the ETF space. And so I wonder if they're participating here or not. But yeah, clearly people have or investors have focused on the AAA this month.
Right. Yeah. Okay. Moving along here. It tells you about the different people involved in the different space. So we saw that improvement in AAA, and it kind of shows up in the BWIC D&T percentages. So the blue represents what was traded. This is out of all the bonds that hit a list. The orange, the D&T, and the gray, no information. So we moved up from a last 12-month average of 54% of AAA's trading to 67%. So certainly, a lot of that was put into AAA, did get done. AAA actually, investors tend to be also the worst with sharing color. Where it's just, and you see this is actually a bad month for the AAA, but they're so it's only about 30% of the market did, the times it didn't share color. That's been greater than 50% at times. So the shape that we have here with the orange, the D&Ts, that's something that we see as you go down the cap stack, that you have a larger D&T, which of course the portfolio metrics mean a lot more as you go down. So you see that, and then in the middle here, a single A and a single B particularly, well, even you can call it a double B, the D&T percentages are quite small.
Yeah, well, AAA investors are very private people, Rob. So
Right, yeah.
That's about all I can say.
That's true, yeah. So, all right, this really interesting how the dealers have participated in the market here. This is the net the net buys and sells over by month. We update this monthly on our site, and you can see back in September that things were much wider when the dealers started to get long. Certainly throughout the fourth quarter, they did into February too, in January. 184 million in March, lightening up. I wouldn't exactly call that a risk off period here, but what's your thoughts on what the dealers are doing here?
Yeah, well, I think they're being very perceptive. They typically, I would have, I guess, coming into this chart, I would have thought that we would have seen some de-risking on the quarters. We didn't see that. I think I think the dealers were, aggressive or active in adding some risk coming into a new year, and seeing kind of the annuity space be very active in terms of what their demands are. Spreads have been very well received from a dealer's perspective. I also think banks themselves, just looking at kind of some their own inventories across different asset classes, I'm sure they were looking to downsize their CMBS positions and some of the other more kind of stress sectors, if you will, and then add to the CLO space.
Right. Yeah. All right. So you don't participate in the equity, but we keep track of it nonetheless here. Just to explain what we're looking at, it's kind of a mess of spaghetti here. The circle with the 33, that's where we are. So we're listing out the months of the year, and the blue is 22, followed by 2023, and then the gray 24. What we're seeing in equity in March, even though it's a quarter end, as you can see in April, these are payment months. So January, April, July, November. These are the payment months where you start seeing equity trading hands. It's been a strong market. 33 trades, over 150 million trades. It's pretty strong. What we saw at the last towards the year end, we a lot of these equity portfolios were strong cash flows, and so you saw quite a bit take hand. But I think we might anticipate, come April next month, that it's going to be very strong volume for equity.
Yeah. You know, and part of me says, you know, we've seen such good spread action, or tightening up the stack, that you may see, you know, some pretty active equity activity as well coming up in April.
Now we move out of the secondary portion now, and we're going to take a look at the new issue, which is really been the big story of the market here. And what we see here for the quarter compared to 23, you know, we're up 41% in just new deal transactions alone. You know, all of 2023 it was 117 billion in deals. 2022 had 129. You know, it was a very strong month and quarter for new issue.
Yeah, it's we really kind of got out of the gates pretty aggressively in new issue, and you know what gives me kind of optimism, if you want to use that word, for continued volume, is that a lot of the levered loan issuance volume has been for refis, and really the M&A space hasn't. And LBO space hasn't taken off, so I think we'll see, additional needs there. I do think, open warehouses are, at least within historical averages. So, and you may see some deals, called, that are post reinvestment period, given some of the some idiosyncratic things that are taking place in the market. So, I do think we're going to see continued new issuance volume. I mean, banks, have really done a pretty good job in terms of kind of protecting their market relative to the private credit space. So, they've, I think we'll see, a continued trend here.
Yeah, yeah. Well, obviously it's contending with all this refi and reset activity that we're seeing, where it really kind of blows up. We see it in March continue, particularly in the refi volume, really kind of catching up with the resets what we had. Overall in March, 19, just under 20 billion so far in refis and resets. That's 39 billion for the quarter. I think of all of 2023, we had 24 billion, but then again, we came to last year where spreads are north of 200 now, and now we're call it 150 if you would, maybe even, depending on who you're looking at there. What are you seeing from your end?
Yeah, I mean, I think there's still, going to be quite a bit of active volume. You're looking back to 2023, you really didn't have any refi reset activity. I think we kind of hit a wall of sorts, just given where spreads were at, and a lot of a fair number of managers didn't refinance, just given kind of levels and given where their levels on the deals were. So it was a little bit challenging to do that. So I think there's given where spreads are at and new issue spreads, I think there's a fair amount that'll still be coming. Whether it's resets or refis, hard to say what the mix will be. I think it depends somewhat on net asset value of the manager, but I think we will see quite a few of these deals for the, I guess, foreseeable future.
Yeah. How much of the refi and reset market gets in the way of new issue spreads?
That's a good question. I really don't have a good answer for you. I suspect that it doesn't. Again, it to the extent that it's similar in tenor and kind of collateral and what have you, and if it's within the market, there might be a concession here and there, but I think it's kind of comparable. I don't know that it impacts it that greatly.
Gotcha. Well, let's continue. Let's look a little further at what might be coming up in the horizon. So this chart that we put together monthly, the way to look at it is this. We look at the center row right here, 150 to 175. It's saying that for all deals that are past their no call date or within 3 months to their call date, there's 165 billion of outstanding deals with those coupons. And so that's we spoke about this earlier, and then you look the one before, like there's a ton of deals here, 527 billion that fill in the bucket before 125 to 150. So, I mean, with that much volume, it asked us to kind of break that down a little more. And so I'm going to jump ahead to the next slide. And what we've done here is we split up these buckets 140 to 150 and 150 to 175. But we're also looking at this from the perspective of a reinvestment date. And what are you seeing here?
Yeah, I mean, I think even before we get to this bucket, I think there was 140 billion that was possible that we might look to see a transaction on just from 175 to 225. So just a bunch of volume that has a potential, let's say.
Right.
Going back to the next page, I think if we think depending upon where spreads migrate towards, but they're starting to be kind of hitting that 150 mark. If they go below, I think that just opens up another category of deals that might look to do a transaction as well. So I focus on the 150 to 175, and as deals are nearing their reinvestment end period, I think that that's a number that will probably have a pull through rate for sure.
Gotcha. We're also looking at short dated deals versus longer dated deals. A little more short dated deals to come. I know people are looking to extend duration, but what do you think about what's going on in the short space here?
Yeah, I mean, I think short dated deals. We're definitely not seeing the number of them that we saw back in like 2022. I want to say some of the uncertainty in the market and what have you. I think it also there may be some impacts from all the from the loan space that are but priced above par. And I think that may impact kind of the preference for kind of a longer dated type of structure.
Right. Gotcha. We're breaking down here. We're just going to look at the AAA. You can see how, for the past year, even longer now, we've really kind of tightened back in. There's certainly not the dispersion that we're seeing. We're inside. I guess you probably call it, low part of 150. You want to average it out in AAA spreads, but seem to be slowing down a little bit right here in the tightening of the AAA spreads.
Yeah, I mean, I don't think. I think it'd be hard just given where spreads are. That to see a lot more tightening necessarily. Just given right now they're really in kind of a 10 percentile type range, and so I think there's a possibly a pause taking place. I think spreads have tightened and the dispersion between managers has kind of tightened as well. So there's only we're below our historical averages, and how much more that can go. I think it remains to be determined. I think we have some. I think we have some unknowns coming up. I think the Fed presumably is at the peak rate, but fewer cuts, potentially. So what impact that has. The economy, I think people are pretty comfortable, but a no landing doesn't mean necessarily growth either, and or a lot of growth anyway. But so I think there's some unknowns that you need to kind of take into consideration. Flows have been great, and I think that's driven some of the spread action. How much that continues, I think, is another unknown. And then we have a big event in November coming up that also may create a little volatility.
Right. Yeah. I wonder what that is. How about in the other asset classes that you looked at? We spoke about earlier the secondary market, but are you seeing kind of a sideways go for other asset classes in AAA spreads too, or is it just more? Is this more something more exclusive to the CLO market?
Yeah, from our perspective, just looking at kind of Z scores, not many positive Z scores out there. There's few asset classes, across the structured products landscape. I think we still like the carry. But I think it's been a challenge to find, obvious opportunities anyway. So, and that includes CLOs.
Okay, cool. Well, we're heading into the home stretch here, and what we'll do is next couple of slides are kind of different views of the same thing. What we're looking at here, I'll start kind of over here, is what we're looking at is the AAA space is so big that you really don't see the movement as much relative to the rest of the capital stack. So we're going to talk about the rest of the capital stack there too, and if you want to mention some of the basis between these, as well as what are your thoughts on new issue and where the ARB stands, and we can kind of move forward with these last couple of slides as we head kind of in. I guess if you want to start at this particular slide here too, you can see particularly the bottom part, for new issue, double B has tightened up. Triple B is experiencing a little more dispersion in new deals. Where do you want me to land this? If you want to talk about the relationship between the new issue prices and the tranches.
Well, I think here is fine. I think we've seen kind of we're at the tights from 2024 and 23 types of spread levels across the stack down to triple B. So it's certainly been I guess what I would say the risk appetite has been very good. I don't know that this is going. There's a lot more to go here, but I think we've been we've seen a really good first quarter. Just kind of looking at triple B to triple A, it's very expensive to buy a triple B bond, it seems to me anyway, just given it's at least a standard deviation from the average. So a little fairly expensive, where we are currently. So I guess I don't know that I see a lot of tightening going forward. But again, if I knew that, I'd be doing something else. So
right. Yeah. So here we have showing the bases of a triple B versus triple A, and then double B versus a double B basis as well, and you can see them tightening as well from what were earlier in the year.
Yeah, it's I think you look at different risk metrics between the bases. The entire curve is flattened a little bit. And I think looking at percentiles, seems a little expensive currently.
Okay, great. Well, we covered quite a bit of space in this bit of time here. A lot of data here. Secondary space. Things have gotten tighter. Obviously, the volume, the liquidity is still there. It's slowing down just a little bit. The reset, refinance market is still growing. However, some of the new deals is slowing down a little bit. What might you think we might expect to see in the coming month, in the coming quarter? What do you think if you look at the tea leaves?
I think, personally, I think spreads kind of move sideways, maybe tighten a little bit. I think we do have some idiosyncratic things going on in the market. I mean, I'd assume everybody is aware of the Altice issues. So I think,
Right.
How that impacts deals that are beyond reinvestment period and whether they get called. Do we have additional idiosyncratic events? Let's face it, the Fed, if they don't, lower rates, higher rates are kind of a negative for levered loan borrowers. So,
Right.
how that impacts default rates and some of the and returns to equity, I think is unknown. I think you also, you do have the kind of the friction between broadly syndicated market and the private credit market. And where do we see how that kind of either merges together or competes together, and so or competes against each other. And so some of those things are still I think pretty big unknowns.
Great, great. Well, we really appreciate your time, Mike. Like I said, a lot of data in a short period of time. We appreciate your view on markets, particularly coming with the different asset classes you see. So thank you for joining us today. And I want to thank everyone else for joining us today with Copatec's monthly report. And we look forward to you guys joining us next month for the April and see where we end up. So thanks again, Mike, and we'll talk to everyone soon. Have a good day, everyone.
Thank you. Appreciate it.
Take care. Bye-bye.